So today, our focus will be on how climate risk affects banks. Emphatically, we'll be looking at the transmission channels. What are the channels or mechanisms or mediums in which climate risk affects global banks or national banks? So, an introduction. Climate change has evolved beyond merely an environmental concern to becoming a systemic financial risk capable of threatening the resilience of banking institutions and the stability of the broader financial systems. So, climate change affects both banks' financial risk, the market risk, which is sort of systemic in nature. Historically, banks have focused on traditional financial risk, such as credit, markets, liquidity, and operational risk. So, if you look at fundamentally, banks have focused on the traditional liquidity, operational, credit, and market risk, which are the core risk of banks. But recently, climate change has been embedded as a multiplier effect on the risk of banks. This explains why central banks, financial regulators, international organizations such as the Task Force on Climate Related Financial Disclosures, also including the Basel Committee on Banking Supervision, the Financial Stability Board, which actually created or formulated the TCFD, the European Central Banks, and the Network for Greening the Financial Systems have integrated climate risk into prudential supervision. So these institutions have actually embedded the ideas of climate risk into the banking mechanisms on the banking platforms in order for banks to actually embed climate risk into their operations. So in this presentation, I will examine how physical and transition risk transmit or the mechanisms through which they transmit to the bank's balance sheet and influence four major categories of financial risk. So if you look at the physical and transition risk, they affect the accounting equation, which is also the assets, the capital and liabilities of banks. So we look at the mechanisms through which they affect this accounting equation, which is the credit risk, the market risk, the operational risk, and the reputational risk. What are the credit risk transmission? If you look at the fundamental basis of why banks operate, the reason is they actually have funds from liquid sectors to illiquid sectors. So they actually provide credits. So how does climate risk affect the credit transmission? Credit risk represents the most direct and arguably the most significant transmission channel through which climate risk affect banks. So banks depend fundamentally on the ability of borrowers to generate sufficient cash flows to service their debt obligations. So if you look at it technically, how does climate risk affect this credit risk transmission? So we look at the two climate risk, which is the physical risk and the impact of transmission risk on credit risk of banks. Physical risk affects collateral levels. How do they affect the collateral values? Most collateral values for banks are mortgages or houses or probably physical assets. So they affect mortgage lending, which provides a useful example. So properties located in flood-prone areas or areas affected by droughts or coastal regions may experience significant reductions in market value as climate vulnerability increases. Consequently, even when banks recover collateral values following defaults, the recovery value may be substantially lower than originally anticipated. So technically, physical risk can affect the value of collaterals and could also affect the lending spread, which is sort of the interest rates based on areas affected by natural disasters or extreme weather events. So, what are the physical climate events may disrupt business operations also? They could destroy productive assets and reduce future earnings. So, they could affect the assets of the bank, which is sort of the revenue of the banks due to natural disasters or extreme weather events. They could also affect the agricultural business sector, which are non financial companies, such as decrease in yields due to prolonged droughts. Tourism businesses may suffer substantial revenue losses following hurricanes or coastal floodings. Manufacturing firms may experience supply chain disruptions caused by also extreme weather events. These developments could also weaken borrowers' capacity to repay and increase the probability of default, which is one of the major risks of credit. What's how does transition risk now affect the credit risk? If you look at transition risk, there are fundamental transition risk like technological change, things like demand change, and also policies and regulations that actually affects the transition into a net zero economy. So transition risk creates a different but equally important source of credit deterioration. As governments introduce stricter climate policies, carbon pricing mechanisms, and environmental regulations, firms operating in carbon intensive sectors experience declining profitability. So firms that actually operate in carbon intensive sectors may actually have a serious effect on their profitability. So industries such as oil and gas, cement, aviation, and heavy manufacturing may face higher compliance costs and lower future demand. So as we move into a net zero economy, there is a higher risk for carbon intensive industries, and this could actually adversely affect banks. So some productive assets eventually become stranded assets. Assets that lose economic value before the end of their expected useful life. So if you look at example, the fossil fuel industries, there could be a high level of stranded assets due to fossil fuel reserves that are probably not being fully utilized in the future as we move into a net zero economy. So consequently, banks experience deterioration in loan quality. There could be deterioration or a reduction in low quality for carbon intensive sectors. There could be higher non-performing loans as we transit into a net zero economy. There could be lower collateral values too as carbon intensive assets become stranded. There could be increased expected credit losses due to stranded assets from carbon intensive industries, especially the fossil fuel industry or higher carbon emitting industries. So, what other risk factors affect banks? We look at the market risk. And when we talk about the market risk, we're talking about the systemic risk of sectors or industries. Climate risk also affects banks through fluctuations in financial markets. Banks hold substantial investment portfolios comprising equities, bonds, foreign exchange positions, and commodity related instruments. Climate related information can trigger rapid market repricing. So, if you look at market risk, it's sort of a fundamental systemic risk that could affect different sectors, whether it's the banking sector, it could be the fossil fuel sector, it could be the manufacturing sector, but it is more inclined towards the carbon intensive sector. So we look at the transmission channels. How does fiscal risk affect the market risk of the carbon intensive sectors? Climate risk can adversely affect the operating income and revenue streams of non financial firms, particularly those operating in climate sensitive sectors such as agriculture, fossil fuel production, maritime transportation, and fast moving consumer goods. So, fiscal risk will affect sectors that are carbon intensive due to flood, hurricanes that can actually affect their physical assets such as buildings, plants, and machineries, who could actually have a major impact on their revenue generating capacity. Extreme weather events can reduce corporate profitability and weaken investor confidence. Consequently, it could lead to downgrade ratings of borrowers. And if there's downgrade rating of borrowers, this could actually affect their interest rates and it could affect their borrowing capacity. It could also affect sovereign credit ratings. So countries could be affected due to high physical climate impact, especially the developing countries. So also, banks holding these financial assets experience immediate mark-to-market losses. So mark-to-market losses due to future earnings could really be affected due to fiscal risk of different sectors prone to carbon intensive industry or carbon emitting industries. Transition risk. How does transition risk affect the market risk? Things like climate policies, regulations, legal implications, technological change, demand conditions could actually have a major impact on the market risk. So we are looking at transition policies generate another layer of market policy or certainty because of the market is sort of volatile and it changes. It could actually affect the systemic risk of banks. So things like carbon taxation, emission reduction targets or mandatory climate disclosures, technological change, demand conditions often trigger substantial portfolio reallocation by institutional investors. So institutional investors actually have a signaling effect due to transition risk. So transition risk affects how institutional investors react to climate change impact, and this could have an impact on both the equity and bond portfolio of banks, as institutional investors are highly invested in banks across the globe. So, according to the climate risk premium hypothesis, investors increasingly demand higher expected returns for holding securities issued by carbon intensive firms, especially fossil fuel industry. So, if you look at it, for banks to actually invest in carbon intensive industries, they need a higher return. That actually creates a different level of transition risk as banks or as nations move into a net zero economy. It exposes the bank to a higher level of risk, which could be a serious backlash or a serious downturn for their profitability and exposes them to risk, which could actually affect their portfolio. This increases the cost of capital too for affected firms while simultaneously elevating their overall risk portfolio. So, as we move into a net zero economy, banks are exposed to a high level of transition risk for non financial companies as banks lend to them. This increases their level of risk. This may result also in higher energy and commodity prices. So, higher energy prices and commodity prices are the aftermath effects of the transition risk, which exposes the banks to such sectors. Operational risk. Climate risk also creates operational challenges for banking institutions. Let's look at how physical risk affects the operational risk of banking institutions. Extreme weather events may disrupt banking operations through what? Physical damage to headquarters. So headquarters could be damaged. So banks should actually sort of have policies for continuity of businesses to actually operate in branches, but this could actually have a physical impact on their assets and the accounting equation, which is quite a key factor. Branch networks will actually affect their payment infrastructure. It could affect their communication systems, their data centers, which could be a major downturn on their operations. So, beyond physical damage, business interruptions may affect customer service delivery, and it could increase operational costs associated with disaster recovery and business continuity planning. So, how does transition risk affect the operations of bank? Transition risk increases operational complexity. Banks must invest substantially in climate risk modeling. Banks should be able to model the climate risk scenarios in terms of the future. How does the climate impact affect their businesses? How does it affect the non-financial companies? Things like stress testing should be done in order to actually forecast the future. It could actually affect the ESG data infrastructure, which is the environmental social governance data infrastructure. It could also affect their staff training. So banks need to train their staff. They should actually have finance staff, even operations staff that are trained in climate risk factors in order for them to actually face the future challenges of transition risk of climate impact on their activities and operations. It could actually have a regulatory reporting system. So, since we actually have disclosures, which is sort of like the TCFD, the Task Force on Climate Related Financial Disclosures, or the IFRS S1 and S2, which is sort of deals with sustainability and climate risk disclosures, it could actually create a different risk factor for banks. So banks should actually sort of be educated in reporting this system, since these are probably likely to be mandatory and regulatory in the future. There should be scenario analysis in terms of various scenarios which could actually affect the bank's strategy in terms of meeting their future obligations as a going concern. There should be governance framework. If you look at a lot of disclosure framework, there should be governance framework, those that should be charged with such responsibilities of taking climate risk into their operations in terms of embedding them into their risk management framework in order for them to be resilient in the future for dealing with such risk factors. So, failure to adapt may expose institutions to regulatory sanctions, operational inefficiencies, and increased compliance costs. So, reputational risk. How does physical and climate risk affect the reputation of banks? Reputational considerations have become increasingly important within modern banking. Institutional investors, regulators, and civil society now scrutinize banks' financing decisions more closely than ever before. If you look at things like principles for responsible investing or principles for responsible banking, a lot of institutional investors need to actually watch that banks actually sort of take the things like climate risk factors into cognizance in their operations before they probably invest in such banks. So banks that continue financing carbon intensive sectors may experience declining investor confidence, may experience customer attrition because a lot of customers, especially the high-end customers, want to actually invest or probably trade with banks that are sort of environmentally friendly. It could actually lead to shareholder activism. There are a lot of activism around banks financing fossil fuel industries. Things like stop the money pipeline, no fossil fuel, no tanks. So these are activism against banks financing fossil fuel industries. It could lead to increased regulatory scrutiny. It could lead to reputational damage. So conversely, banks demonstrating credible commitments to sustainable finance often strengthen stakeholder confidence, enhance franchise value, and improve long-term competitiveness. So in concluding remarks, climate risk should no longer be viewed as a distant environmental concern, but rather as a material financial risk with profound implications for banking stability. So, climate risk should be embedded into the banking framework, into the banking strategy, risk platform, governance structure, metrics, and targets for them to actually meet the changing or dynamic business environments. So, physical and transition risk influence virtually every aspect of banking, whether it's the assets, whether it's the capital or the liabilities, from credit quality and asset valuation to operational resilience and corporate reputation. So, as climate change continues to reshape global economic activity, banks must strengthen climate governance, integrate climate considerations into enterprise risk management frameworks, and undertake rigorous climate scenario analysis and enhance climate related financial disclosures.